Welcome back to Switzer and Australia's Business Channel. Professor Warwick McKibbin is an internationally highly respected Australian economist. He's a former Reserve Bank Board member and has the longest title in the history of academia with his economics chair at the ANU. That aside, there are a few economic problems Warwick does not have a solution for, and he joins us from our Canberra studio. How are you, Warwick?
Hi there, Peter. I'm well, thanks.
I wasn't even a chance of putting that full title of your title at ANU. Where did that come from?
I'm presuming you're talking about the Vice Chancellor's chair in public policy.
Yes, it was the longest title ever. Anyway, only you could have a title that long, and that's because you're so good at what you do. Now, Warwick, let's start off with a lot of questions that people are really worried about. Housing bubble. Are you worried about housing bubble?
You mean in Australia or
yeah,
other
Australia.
parts of the world? I'm more worried. In Australia, at current interest rates, I wouldn't say there's a bubble. The problem isn't now. The problem is when interest rates start to return to more normal levels. What will happen to the housing market? That's the key question, and that's what I'm more worried about, is people overextending borrowings and other cracks that will emerge once we put the financial system on more normal footing.
Okay. How vulnerable are our banks to what they're doing in the home loan market?
Well, again, I mean, our banks are well capitalised. The monitoring systems we have in Australia are world class. I'm not too concerned. There is some issues about whether we have a shock in Australia that coincides with a global financial shock that changes the capacity for the banks to raise funds overseas in a very serious way, as we saw in 2009. But I think just if we have a correction in Australia as interest rates start to rise, the economy can handle that.
Okay, the Murray inquiry, are you expecting a very aggressive stance from David Murray?
Well, again, I've kept very well clear of the Murray inquiry, so I really don't have a position on that at this point. Okay, but okay, you have a position at that point, but given the fact that you're not particularly worried about our banks, unless a really serious financial crisis happens, on that basis, you're implying that we don't need immediate action anyway. Well, I mean, I think the biggest problems aren't really the degree of capital that's in the banking systems. The problem is the special position that banks have in terms of being able to raise funds with a government guarantee without actually having to pay for it. So there's some issues to do with more efficient use of resources in the financial system. And again, I'm steering clear of the Murray review. I was away for most of it. I spent the first 6 months of this year in Washington, so I've just kept completely away from that particular set of issues. Okay, well, let's just deal with the issue you brought up then, so like the cost of finance and all that sort of stuff. If you look at what might happen down the track, are you seriously worried that when we get to a normal economy and say interest rates rise by maybe 2%, the cash rate by 2% over about a 3 or 4 year period, that could lead to a serious economic dislocation? No, I'm not worried in the context of what's happening in Australia. I mean, if Australia was an island, which we are, this adjustment could be handled. The key question is what's going to happen in Europe, what's going to happen in China, what's going to happen in Japan. Those external forces are far more important for the Australian economy, in my view, than the current situation with low interest rates. My view is that rates shouldn't have been pushed as low as they were. I understand why they were, but I think that we need to have a financial system that's allocating capital in a more conventional way, and I think rates in Australia are too low for global reasons. Yep. Europe then, what's the big worry there? Well, the big worry in Europe is financial systems are under incredible stress. We have countries in the south where youth unemployment is 60%, where full unemployment across the entire population is pushing up to 35 to 40%. These economies are being crushed by the need to stay within the common currency zone. And now we're seeing that spilling over into France and Germany and slowing those economies quite significantly. So we have an economic system that's not viable. And so we know how to fix it. The Europeans know how to fix it, but it's a very big ask to get this done in the time that we have remaining. With the adjustments in the ECB, with the very long period of quantitative easing and zero interest rates, the government should have been reforming their economies, and they haven't. And so they've got themselves into a very, very serious situation. So
can Mario Draghi do a lot more than he's currently doing to take the pressure off those governments haven't got the guts to really take on the fiscal strategies required?
So to answer that question, just look at what the problem is. Debt to GDP in most of the European economies is over 100%. That's excluding Germany, which is above 80%. So at zero interest rates, you can almost survive that amount of debt in the system. If interest rates start to rise with negative economic growth, that starts to explode. Now, the problem is that the financial system has a set of banks who are pretty much undercapitalised and relying on the valuations of government debts on their balance sheets to be capitalised. This whole relationship between the sovereign risk and the corporate banking risk is where the problem is. Now, what can Mario Draghi do? Well, he can do what he's been doing, but not forever. What's required is a very, very serious adjustment in competitiveness in the south, structural reforms, fiscal transfers from Germany to the peripheral countries to help get the economies to grow again, a big investment boom of infrastructure, capital accumulation. It's a very, very big ask, and the governments have done almost nothing in the period that Mario Draghi has bought them with the very low interest rates in Europe.
But Warwick, the one country who should understand all this and realise how vulnerable they are is Germany, because if Germany doesn't make this whole Eurozone work, the whole thing's going to fall apart. So why is Germany playing the obstructionist role in this whole battle between all the countries in the Eurozone?
Well, it's an interesting internal balancing act, because if you look at Germany since for at least a decade has benefited from very strong productivity growth coming from labour market reforms. On top of that, they've had a very weak currency because the currency of the euro reflects the entire zone. So Germany's had an undervalued exchange rate, which has benefited their export sector a lot. So Germany was, up until a year ago, growing very handsomely out of the eurozone arrangements. And even now, exporters know that if somehow you delinked the Deutschmark from the rest of the Eurozone, it would rise substantially. And we've modelled this, and it causes a serious recession in Germany. So there's balancing interests between exporters and taxpayers. There's balancing interests between different groups within the German society. There are winners and losers, and the key issue is when will the number of losers dominate the winners from having the Eurozone? And again, in the end, the Eurozone is a political process. It's not an economic process. The economics have failed a long time ago. The question is, when will the politics fail?
Okay, so you're scaring us about Europe. You're going to scare us about China as well, and if so, why?
Well, no, I'm actually quite optimistic on China. If you look at the incomes per capita in China, they're about 20% of the US. If you look at productivity in China, productivity growth, it's about 20% of the US. So China has a long way to go to catch up in terms of per capita measures to the frontier economies. So if you're looking forward, there's a long way for China to grow. There's a lot of growth in incomes in the middle class. This is a very optimistic picture for countries like Australia that will be involved with China over the longer run. The key issues in China is how to deal with the adjustment that needs to do, moving away from external demand and investment, massive investments in the economy, to more normalised growth coming from consumption and more balanced growth in the economy. So there are various pockets of adjustment that are needed. Some of the housing markets are showing signs of overheating. Housing prices are falling in some cities now. But there's a lot of structural reform to be done. But the Chinese government is doing it and has been doing it for some time. So I think there will be potholes, and I think the fact that China is slowing down probably to 7% growth is a good thing as long as it's being caused by structural reform. From the outside, that's what it looks like, but China's a very complex economy and society, and there may be some things in there that we're not fully understanding. But in the medium to long term, not just China, but emerging countries in general, it's a very optimistic view.
Okay, so given that, let's try and put it all together for my viewers who might have been worried about what you said about Europe, but who feel a bit more relieved on your China view. Is Europe going to be the sort of thing that could really rock financial markets inside a year or 2 years? And if you think a financial rocking is going to happen, how long do you think before that would happen?
So my view here is that the big trigger here is actually not Europe. The trigger here is success in the US. With the economy in the US growing faster than many expected, and the problems in Europe, capital will start moving from Europe into the US economy. Now, this is to be the trigger for world interest rates to rise because US interest rates are rising, but also because capital is being moved around the world economy. So in that sense, I think the US economy is well placed for a crisis in Europe. I think large parts of Asia, particularly Japan, Korea, are well placed. Australia is well placed. So this is not 2007 to 2009 being repeated, because that was a global problem where economies were synchronised on the downturn. I think this time around it's quite more complex. I think the European financial system could be in for a serious adjustment, but I think the rest of the world, depending how policymakers respond, is in a pretty good place. Now, the problem there is if they go down the road of trying to respond by more fiscal stimulus this time around, that'll be a problem, because Europe's core problem is too much government debt. And so this shock is different to the shock that we saw 5 years ago. And so the response has to be very different. And I think the G20 is an important time to have this meeting with Australia in the leadership role that it is. Yeah. Because we can deal with this crisis when it comes, and there will be some crisis in the world economy in coming years.
The interesting thing is, Warwick, I know back in about 2008, 2009, when a lot of economists were very anti what the Americans were doing, I was doing a presentation, you were in Canberra, and I was really happy that you agreed with me that what the Americans were doing, even though it wasn't something that we necessarily wanted any government to have to do, it was the right thing for the time. Do you still think that?
Well, again, I think the quantitative easing by the Fed was necessary. It was very dangerous, but the US fiscal position was behind this. The Congress was stalled. Yeah. Government debt in the US is 100% of GDP. So the US, they're in a position they shouldn't be in. But the good news was that during the adjustment from 2009, the balance sheets of households and corporates were cleaned up. The balance sheets of banks were cleaned up. The balance sheet of the government wasn't, and that's a vulnerability. But they actually undertook reforms that we haven't seen in Europe, and that's the difference. That's the contrast.
Yeah. Warwick, thanks for joining us on the show.
Always happy to be here, Peter.
Thanks, Warwick. Coming up, we take a close look at investment building.